So here's our chapter, Understanding Financial Management and Securities Markets. So let's get into what that means. What is financial management? Who within a company manages the finances? How do they do that? And what do we mean by securities markets? Let's find out. So there are people in corporations or in businesses whose job it is to manage the company's finances. This is different from accounting. In accounting, you're basically keeping track of the money and making budgets and estimates. But in finance, you're trying to figure out where to get money from. If a company needs more money, you've got different options. And if you have extra money, you've got options about how to invest it. So that's the main role of the financial manager, which, as you can imagine, ties into the strategy of the organization, right? Because companies need money to grow, they need money to pay their bills, and when they have extra money, they need to invest it in a way that's smart. We'll look at the different expenditures or things that companies spend money on, both short-term and long-term. If a company is going to borrow money, it might take out a short-term loan or a long-term loan, and it might have to secure that loan with some capital, with some asset, so that if they don't pay back the loan, the lender can take that asset. It's kind of like if you buy a car and you finance it, and then you stop making payments on the car company can repossess your car. So you secure the loan with that vehicle. And by doing that, you tend to get a better interest rate. If you, for example, take out a credit card, which I'm not recommending that you do, but credit cards are not secured. So the interest rates tend to be higher. Same thing with companies. Sometimes they secure their loans with assets, and sometimes, secured, and sometimes they don't secure them. Again, we'll talk about how debt differs from equity. Basically, for this chapter, think of equity as stocks. And bonds are a form of debt. We'll talk about long-term debt. When you take out a long-term loan, you tend to get a better interest rate than you would on a short-term loan. That kind of depends on the situation. We'll talk about how companies actually issue stock. How do they go? Well, first of all, they have to be a corporation, and they have to have approval by the state, but then they can sell their stock. Some corporations only sell their stock to private investors, but some can actually have their stock sold on a stock exchange. So we'll get into how that works. A stock exchange is a market for securities. Securities include both stocks and bonds. And investors can buy and sell stocks and bonds over the stock exchange. These stock exchanges are regulated. Does anybody know who regulates the stock exchanges? So it's the Securities and Exchange Commission, or the SEC. We'll talk about them more later. We'll also talk about developments in finance and the securities markets. So I want to spend a few minutes looking at this particular chart, because I think it'll help you understand that concept of risk versus reward that I mentioned earlier. So let me see how well I can zoom in. Oh, that's perfect. Okay, so what I want you to do is imagine it's 1926, a couple years before the great stock market crash of 1929. That was right at the start of the Great Depression. It took us more than a decade to recover from. So if it's 1926 and you had $1 that you wanted to invest, you've got some options. Now, let's say you just held on to that $1. You didn't invest it. You just kept it for 83 years. And so now it's 2009. You still have that dollar. Well, things that used to cost $1 now cost $12. This gray area here shows inflation over time. So that would not have been a smart choice, right? Holding on to that dollar and then losing purchasing value. You can't even buy a candy bar for $1 anymore, right?
Yeah.
Maybe if you go to the dollar store, but then you have to pay tax. It still comes out more than $1. So in general, we can expect that there's going to continue to be inflation. And I think when we had our chip, did I start recording?
Yeah, you started
I
recording.
did?
Yeah, you did.
Okay. I'll take your word on it. I really don't remember
Actually
doing it.
ordered a Gateway computer for $144 on eBay.
Oh, really? That's not bad. Well, electronics sometimes go down in price, which is kind of nice, but most things tend to go
That's
up
a
in price.
Pentium 4 based computer.
Not bad.
It's okay. 4 processors.
So if you remember back to our chapter on economics, I think I talked about how a little bit of inflation is actually good for the economy. It seems kind of counterintuitive, but if you didn't have any inflation, people wouldn't have any motivation to invest. And they'd have less motivation to go out and buy things because prices are going down. You can just wait and you could get it cheaper later. So the way our market-based economy works, it's actually best if we have a little bit of inflation, something like 2 or 3%. And over time, that adds up. Now, if you look, I know it's kind of hard to see, but there was a period here during the Great Depression where we did have deflation. Prices were coming down, if you look at that gray area. So that dollar, when prices are going down, becomes worth more and more. You could buy more stuff with that same dollar. But that didn't last very long, right? As we started to come out of the Depression, prices started to come back up. By, this is getting close to World War II here. Now inflation's back. It brought it back to where it had been before, as far as the purchasing power of the dollar. And then over time, again, it now costs $12 to buy what would have cost $1 83 years earlier. Right? So it's a good idea to invest if you have extra money that you don't need, for no other reason than it helps you stay ahead of inflation. So you're not losing purchasing power. Now, one of the safest investments out there is treasury bills. Does anybody know what a treasury bill is? What do we mean by that term? We're talking about the US Treasury. So if you buy a treasury bill, you're actually lending money to the US government that will get paid back to you with interest. And the US federal government has never failed to repay its debts. So it's a very safe investment. These treasury bills are short-term investments. They're for a matter of months, typically. So you're making a short-term loan to the government, and then you'll cash it in and you'll get your money back with some interest, but not a lot. Historically, it's only been 3.7% interest, a little bit better than the historic 3% inflation. So if you had invested that dollar in treasury bills, you see that over time, it would have grown to, what is that, $21. You turned your $1 into $21. Okay, but it took 83 years to do that. That's not that impressive, right? And in the meantime, inflation is eating away a lot of that growth. So you've really only increased your purchasing power by about a double factor. On the other hand, what if you had bought longer term government bonds? So now again, you're lending money to the federal government, but for longer periods of time, years. Well, those have average 5.7% interest. So you see over time, those have continued to grow. And so your money would have reached $99 starting with that $1 investment. That's a lot better, right? I don't know if that's that won't even pay for dinner for two at a lot of restaurants, right? So that $99 is not that much purchasing power, but it is better than the safer, well, they are safer. Basically the lower interest rate of the treasury bills is a little bit safer than the government bonds, even though they're both really, really safe. Now, let's say instead you had bought stocks in large companies. So back then in 1926, might have been companies like AT&T. All right, they're still around today, but these were some of the large companies even back then. Maybe General Electric would be another one. And these large companies have averaged 9.6% returns. So that's how much the value of your investment would have increased per year during that time. Now, that's the light blue line. So you see that for the first couple of years, from 1926 to 1929, your dollar would have grown really quickly, up to about something like $4 or $5 here. That's a pretty good return in a couple of years. But then, when the 1929 stock market crash came along, that $4 or $5 that you have went down to about 50 cents. And you would have thought at that time, man, I should have cashed out at the peak, right? I should have sold my stock when it was here because I held on to it and now it's only worth 50 cents. But you never know what the market's going to do, right? Nobody knows what's going to happen. And then it recovered over a couple of years. You see it came back up, almost reached that same peak, and then kind of dropped down, bounced back up. And then over time, the stock in those large companies, again, has averaged 9.6% return. So now your dollar over the 83 years would have grown to more than $2,000. Now that's a better investment, right? That's worth holding on to that investment for 83 years to see it grow from $1 to $2,000. But let's say, on the other hand, you had invested in stocks in small companies. Well, those are riskier. Small companies are more likely to go out of business because they don't have as much money as the big companies, right? And so that risk can lead to bigger returns if you pick the right small companies. They have averaged 11.7%. So now we're looking at the kind of dark blue line, or purple maybe, and you see that it dropped, jumped up, dropped down to now your dollar's worth like 25 cents, right? This is after the great stock market crash of 1929. So you would have been thinking, oh man, what did I do, right? I lost almost all my money. Then it recovers, then it drops again. Can you imagine the emotional roller coaster you're on, watching your money go up and go down? But if you held on to it over time, you see it continues to go up and down, but generally goes up. And now your dollar grows to $9,500. Now we're talking, right? That's worth holding on to for 83 years to see it grow like that. Yes, Adriana?
Do you think there should be a limit to how much stock you can own? Like, for example, you have like mega corporations like Vanguard and BlackRock. Like, I believe BlackRock owns like over 30% of single households here in America, and they're like trillion-dollar corporations. Do you think there should be like a limit to that? Because in a sense, it limits their competition.
I think so, yeah. BlackRock is the largest investment company in the world. They have more than $1 trillion in assets that they manage. I mean, $1 trillion, that's a million times a million, right? And so they're very, very powerful. They can influence our entire economy by the decisions that they make. Should there be limits? Yeah, now I think so personally, because what we see in the United States and in much of the rest of the world
understand that.
is a
She said that.
yeah, I think it was Siri.
Sportsman like that.
That's right. Yeah, Siri, watch your behaviors. What we've seen is growing disparity between wealth and poverty around the world, right? the wealthy are just getting wealthier and wealthier, and that's great, except that so much of the rest of the world is struggling just to get by. So how do we fix that? Yes, I think regulation would be appropriate. I'm not enough of an economist, and even the economists don't even agree on how you do it. But that's what our politicians and economists have to figure out. How do we create an economy that works for everybody? So that yes, there is competition. Yes, there is the possibility to start companies that get really big because they provide a product or service that people want, but that there's competition, and that these billionaires and these corporations don't really control our entire country or entire planet, which is kind of the way things are going. Yeah, so there definitely has to be some change. So as an investor, if you're able to look back, it's clear what would be the best choice, right? It's clear that you could invest that dollar in small companies, stocks. And then even though it's going to be rocky, you know that eventually it's going to be worth a lot of money. And so you just wait. However, that's only if you can look back. Nobody knows the future. There's no guarantee that if you go out and you buy stocks in small companies, that they're going to get 11.7%. What's the worst that they could do? If you put money into stocks, what's the worst performance that could happen? If you lose your money, which would mean not only did it not go up 11.7%, it went down 100%, right? That is possible with stocks. There is no guarantee that you even get your investment back. So yeah, historically, that's the investment among these choices. That's the investment that returned the most money. But that doesn't mean that that's always going to happen. Well, okay. Is it possible to go into debt when investing in stocks? That's a great question. If you have money that you're investing, you can lose that money. If you decide to borrow money to use for investing, you could lose that money that you borrowed and you still have to pay it back. So yes, if you borrow money to invest, then that could put you into debt.
Margin call movie.
Exactly. That's what the margin call movie is about. Because a margin call is when an investor borrows money to invest, which is very risky, right? Because if it doesn't work out the way you wanted, you not only didn't make anything, now you've got a debt you have to pay back. So this is really important to understand, because as you go forward in your career, in your life, you're going to have to make some investment choices, right? You can invest in real estate, you can invest in stocks, bonds, businesses, your own business. And most people don't really get an education about how to make those decisions. I generally recommend, even if you know this stuff, even if you've studied it, it's a good idea to work with a financial advisor, because they are not emotionally attached to your decisions. They know what works. Whereas as individuals, we tend to sometimes make decisions based on either greed or fear, right? But if you have a financial advisor, they look at it in a more practical way, and they can help you make better decisions with your investments. And if you have an account at a bank, there's a good chance there's a financial advisor there at that bank. That's generally what I would recommend to start with. Sit down with financial advisor at your bank or at your credit union. Say, look, I've got some money I want to invest, and give me some advice on how to do it. And then they can help you with that. And banks are, they're trustworthy. If you just go out and find some random financial advisor that is independent, you never know, there might be another Bernie Madoff, right? So I would tend to stick, if you're a new investor, I would stick with one that's affiliated with a bank. So any other comments or questions at this point? You know, we're still on the learning objectives slide, but I felt this would give you a good overview about the whole chapter. Andrew.
So is the stock market, is this like when it started to when it's ended? It's always recovered? That's what it looks like throughout the history of stock market?
Well, we could go back, the stock markets, the modern stock markets do go back in the US a little more than 100 years.
Okay.
And like, for example, if you look at the S&P 500 index, that gives you the best way of seeing how the stock market has performed, because these are the 500 largest corporations in the United States.
Oh, not a good day right
But this is historically what our stock market has looked like. This is going back to 1984. But if you went back, you know, to the beginning of the 20th century, it's a fairly flat line.
Okay.
It looks something like this. It's only in more recent times that we had the dot-com bubble. We had the housing bubble and the financial crash in 2008. We had, this is the little crash we had during the pandemic. I think
now.
this was,
Major sell-off yesterday.
yeah, well, we're still at basically all-time highs in the markets. So it's really only been the last few decades that the stock market's just gone crazy. And how sustainable is that? I don't know. That's why when I said we're overdue for another recession, I've been saying that for about 6 years. And it still hasn't happened. And that's great, you know, but it will happen eventually. At some point, we're gonna have an economic downturn, and hopefully it's not gonna be huge. But when I look at the stock market having these record highs, and a lot of the reason in recent years that the stock market's been so high is a lot of these corporations have bought back their own stock. When during the Trump administration, corporate tax rates were reduced, that meant corporations didn't have to pay as much in income tax. And they used a lot of that extra money they had to buy their own stock. And if you remember supply and demand, when you buy your own stock, that limits the supply and that pushes up the price. So I believe a lot of these market highs are really artificial. They're not sustainable. But what do I know? Like I said, I've been saying that for 6 years and it just keeps going up. So yeah, but this is more what the stock markets look like in recent decades. Okay, so let's cover a couple slides and then we'll watch that video about Silicon Valley Bank. What this shows us here is where companies get money from and what they spend money on. So the top part shows companies get money from selling their product or their service. That's typically the largest source of income for companies. They get money from the owners, which if it's a corporation would be the stockholders. That when they buy stock in the company, they're giving money to the company in exchange for the stock. So that's a source of cash. Companies can borrow money. They can borrow from lenders like banks, and they can also borrow from bondholders, and we'll get into bonds a little bit later. A company could sell property that it has, for example, if it owns a building, land, vehicles, equipment, and it doesn't need it anymore, they could sell that, and that would be a source of cash. And when their customers owe them money, that's called accounts receivable. And when they get that money from their customers, again, that's a source of cash. But then companies spend money, right? So what do they spend money on? Well, they have lots and lots of different expenses. Insurance, sometimes rent, wages for their employees, on and on and on. Inventory, that would be either raw materials that they're going to turn into products, or would be actual finished products that they're buying and reselling. All of that would be inventory. Then there's dividends. Who can tell me what dividends are? Yeah, as an investor, it's money that the corporation has given you as sort of a reward for being an investor. So this is only done by corporations, but a corporation's board of directors every 3 months will look at how much profit they've earned and then decide, do we want to share some of that profit with the investors? And when they do, that's a dividend. So they might say, okay, we made $100,000 this quarter. We're going to take $20,000 of that, and we're just going to give a little bit to each of the investors. That's called a dividend. So that's a source of cash. I mean, a use of cash. And then if a company needs to buy equipment, machines, property, that sort of thing, that also costs money. So you see there are a lot of sources of cash and uses for cash. This is a big part of what the financial managers do in a company. They look at where are we going to get money from other than selling our product, and what are we going to use that money for? You know, actually one that's not on here just occurred to me. They could also invest in other companies or in other investments. So that would be another use of cash. Okay, so again, if you work in finance, if your role is to help manage the finances of a company, a lot of that is planning, thinking ahead, thinking, how much money are we going to have in the next 3 months or in the next year? Do we need to find more money? For example, let's say we want to buy another company. Do we have enough money to do that? Let's say we want to expand into another country. Do we have enough money to do that? Or let's say we just want to hire more people. Do we have enough money for that? So planning ahead, figuring out how much money you're going to need, and then where you're going to get that money. You could finance by selling stock. That would be one way to get money. You could finance by borrowing money. That would be another option. So these are the sorts of decisions that financial managers have to make. And if the company has extra money that it doesn't need, how do you invest it? You buy back your own stock. You buy stock in other companies. You buy real estate. How would you invest that money? So these are the 3 primary roles of financial managers. Now, I mentioned before that there is a trade-off between risk and potential return, right? There are no guarantees. And that's what this graphic shows here. The more risk you're willing to take, the more the possible return. I think that some of the best investors have figured out ways to get good returns without big risks. I think they take calculated risks that they know that they can afford. So don't think that, hey, I'm going to go out there and I'm going to buy crypto. I'm going to get rich. Maybe, right? If you bought crypto when, let's say, Bitcoin was less than $1 for a coin, and you held it, and now it's worth, what, $60,000 a coin or something crazy like that? Yeah. What is it? $67,000 for one Bitcoin? Yeah, but is now the right time to buy Bitcoin? I don't think so.
No.
I mean, maybe it's going to go from $67,000 to $1 million a coin. I don't know, but it's pretty risky, right? So if you are a really experienced investor and you've got some unique insights into the market, you might be able to make some really good investments without a lot of risk. Look at somebody like Warren Buffett, considered one of the greatest investors of all time. He went from nothing. He started investing as a kid, buying stocks, but he researched them very thoroughly. very burly, made really smart choices. He's made a few mistakes now and then, but for the most part, he really does his homework, and he's been able to build an empire. He owns, well, he's one of the main owners of this company, Berkshire Hathaway. Anybody know what their stock sells for right now? What is it? $430,000 for one share of stock. I think that's the most expensive stock in the world. Normally, if a stock costs more than $1,000 a share, that's expensive, right? But $430,000 for one share of stock. He's made some pretty good choices in his own investments and his own company's investments in order to build such a successful and powerful company.
Can you just say that since it was back then, it's easier to find stuff that would be better in the future? Stock goes.
Yeah, I think so. I think things have gotten more complex because he started investing when it was still kind of the industrial age. No, not that far back. I mean, he's probably like in his 80s or around 90 now. But things have gotten more complicated, especially with the digital age and the information age, now AI. But again, he researches the companies and looks at, is the company itself a well-run company? And that's how he makes his investment decisions. And it's hard to know that unless you can go and actually meet the executives and see how the company actually operates. Okay, let's see. Let's look at what companies spend money on. So there are some things that spend money on in the short term. We've talked about some of them like rent, insurance, wages. Those are just ongoing operational costs. And then sometimes there are longer term expenses, like again, you're buying a building for your business, or maybe a long-term lease on a factory, something like that, that'll last multiple years. So sometimes if companies make long-term commitments and then things start to go bad with their business, they're committed to repaying these long-term commitments, debts, or whatever they might be. And they might be running low on cash because they're just not selling enough of their product. We saw a lot of that during the pandemic when companies that relied on customers coming in all of a sudden didn't have customers coming in, right? Because of the sheltering in place orders and all that. And so a lot of companies went out of business. So what if that happens? What if you get into a situation where you're low on cash as a company? Here are some options. If you've got customers that owe you money, and that's very common if you sell to business customers, that they will pay you later. Like they make a purchase from you, and then you send them an invoice and you give them maybe 30 days to pay or something like that. It's pretty normal. And so if you're short on cash, you could call up those customers and say, hey, think you could pay us like this week? Or especially if they're late, you say, hey, you were supposed to pay us last week, when are you going to pay, right? So you could try to speed up that collection process. You could also do the opposite. If you owe money to some of your suppliers, you can delay paying them. They're not going to like that because they need money too, right? And they might even get mad at you. They might tell you in the future that you have to pay them up front because you were late paying last time. But it is an option. If you're short on cash, that's one thing you can do. And a third thing you could do is buy less inventory. Imagine you have a drugstore. That's your business. And customers come in and they want to see a lot of product on the shelf, right? Maybe they need some cold medicine. And so you give them like 5 different types of cold medicine that they can choose from. But if you're short on cash, maybe you just give them 3 different options of cold medicine. Maybe you don't have as much extra inventory in your store because that costs you money that you don't have. So those are some options companies can take if they're short on cash. Any questions, any comments? Okay, well, let me show you this video on Silicon Valley Bank. Now, this happened just about a year ago. Because, yeah, time is running short here. Okay, so if your company needs to borrow money, and it just needs the money for a short period of time, here are some options. One is when you buy from your suppliers, they will usually let you not pay them right away. That's typical in business-to-business sales. So that's called trade credit. And when that happens, you now have an account payable, meaning you have to pay that supplier for your account. So that's one easy way to make some purchases without spending money right now, right? But your supplier is going to want you to pay them within a month or two, typically. You could also take out a short-term loan with a bank, assuming that the bank will make you a loan at an interest rate that is acceptable to you. There's also something called commercial paper. Now, these loans can be very short-term, like even just a matter of days. So imagine that it's Thursday and payroll is due Friday. You have to pay your employees $100,000 and you don't have it. You don't pay your employees, they're gonna be pretty upset, right? They might quit, they might sue you, there are all kinds of bad things that could happen. And even if they don't quit, they're not gonna be very happy. It's unsportsmanlike conduct, right? So they're not gonna be very motivated workers. So what you could do is take out a very short-term loan. And this is commercial paper. So basically you're borrowing money just for a couple of days because that allows you to make your payroll. And then when you've got other money coming in, you pay off that loan. That happens pretty frequently. Even banks and large corporations borrow short-term to pay their bills. Another thing you could do is if your customers owe you some money, so you've allowed your customers to make some purchases but not pay you. Well, you can actually, when you apply for a loan at the bank, offer the money that your customers owe you as collateral for the loan. So basically what you're saying to the bank is if we don't pay you back, you can have this money that our customers owe us. And the bank might then say, okay, then we'll make you the loan. Because now we know you don't pay us, we'll take the money from your customers when they pay you. Or the money that your customers owe you, you could actually sell that. It's called accounts receivable because these are accounts that you're expecting to receive money on. You can sell that to a collection agency, and when you do that, it's called factoring. Now, you don't get a whole lot of money for it. So again, let's say you have to make payroll tomorrow for $100,000. So you go to a factoring company and you say, look, our customers owe us $400,000. If we let you collect that $400,000 from our customers, how much money will you give us today? And they might say, oh, we'll give you $100,000. You're losing $300,000. But you get the money right away. So it's not really a good strategy, but if you're desperate, it's called factoring, and that would be one option. Okay. Now, here we see a comparison of debt financing, which again is borrowing money, or equity financing, which is selling stock in your company. If you take out debt, you have to pay it back, right? That's how debt works. You also have to pay interest on that debt. However, you do get a tax deduction. for the interest expense. So that might save you a little bit of money. On the other hand, if you sell stock, your investors give you money, you give them stock. You never have to give that money back to them. It's not a loan. They have purchased part of your company. So you get to keep that money. There's no requirement that you ever buy back that stock. However, by selling stock, you're giving up part of your business. And the more investors own of your stock, the less control you have over the corporation. So that's what companies have to decide. Typically, corporations use a combination. They use some debt and some equity financing. Studies have shown that if you balance that out properly, that optimizes the price of your stock. All right, so let's go ahead and break into groups for the video discussion and see what questions you come up with our remaining, we have only 7 minutes left.
6.5.
6.5, okay. So come up with your group discussion or group questions over the next 7 minutes.
Okay.